Here is part two. Oh boy. Oh boy. Financial Institutions Supervising Act of 1966 expanded bank enforcement powers of the federal banking agencies, permitting regulators to bring cease and desist orders against banks engaged in unsafe and unsound banking practices or other violations of law. Granted the federal banking agencies authority to remove bank officers and directors for breach of fiduciary duty. International Banking Act of 1978, or next is the International Banking Act of 1978, brought foreign banks within the federal regulatory framework, required deposit insurance for branches of foreign banks engaged in retail deposit taking in the U.S. Next, Financial Institution Regulatory and Interest Rate Control Act of 1978 created the Federal Financial Institution Examination Council, established limits and reporting requirements for bank insider transactions. Next, Depository Institutions Deregulation and Monetary Control Act of 1980 established NOW accounts, began the phase-out of interest rate ceilings on deposits, established the Depository Institutions Deregulation Committee, granted new powers to thrift institutions, raised the deposit insurance ceiling to $100,000. Next, Garn St. Germain Depository Institutions Act of 1982 expanded the powers of thrift institutions, expanded FDIC powers to assist troubled banks through such measures as Net Worth Certificate Program, which provided for recapitalization of banks and thrifts that suffered from interest rate shock after deregulation of interest rates on deposits. NWCs, or net worth certificates, were a temporary form of capital that the institution gradually replaced as it became profitable. Next, Competitive Equality Banking Act of 1987, also known as CEBA, established new standards for expedited funds availability, recapitalized the Federal Savings and Loan Insurance Company, FSLIC, expanded FDIC authority for open bank assistance transactions, including bridge banks. Next, Financial Institutions Reform, Recovery, and Enforcement Act of 1989, also known as FIRA, or FIREA, FIRREA, was to restore the public's confidence in the savings and loan industry. FIRREA abolished the Federal Savings and Loan Insurance Corporation, and the FDIC was given the responsibility of insuring the deposits of thrift institutions in its place. The FDIC insurance fund created to cover thrifts was named the Savings Association Insurance Fund, SAFE, S-A-I-F, while the fund covering banks was called the Bank Insurance Fund, BIF, or B-I-F. FIRREA also abolished the Federal Home Loan Bank Board, two agencies, the Federal Housing Finance Board, FHFB, and the Office of Thrift Supervision, OTS, were created to replace it. Finally, FIRREA created the Resolution Trust Corporation, RTC, as a temporary agency of the government. The RTC was given the responsibility of managing and disposing of the assets of failed institutions. An oversight board was created to provide supervisory authority over the policies of the RTC, and the Resolution Funding Corporation, RFC, was created to provide funding for RTC operations.